Hi there, Rebecca Lang here with my Toronto real estate market update for March. It's March break this week, which is normally a quiet time in the market, especially when it's capping off a sluggish and harsh winter. Although our most recent sales stats show some of the slowest number of sales in years, home values continue to modestly increase. As usual, some segments and neighborhoods are running much hotter or cooler than others, and to highlight what's hot, it's a safe bet I'm going to pick on one of my favorite neighborhoods, Leslieville. If you've seen a sold sign on a Leslieville semi in the past few weeks, stats show that it probably had multiple offers after a 7 to 8 day marketing period, and that it sold for 20% over the list price. In these urban neighborhoods with entry-priced homes, there's still a healthy buyer demand, resulting in these underpricing strategies continuing to yield success. Moving a bit further away from the core into neighborhoods like Cliffcrest, Humber Bay Shores, and even East York, the holding back of offers in the hopes of igniting a bidding war is finding more mixed results and sometimes disappointed sellers. It really takes careful analysis and skillful execution of your marketing strategy to sell both quickly and for the top price in these more variable neighborhoods. At the higher end of the spectrum, the Globe and Mail recently ran a north versus south of the 401 Yonge Corridor showdown. It focused on activity in the 2.5 million range, which is a price point that moves a bit slower no matter where it is in the GTA. Not at all surprising, the builder and speculator-laden Willowdale had a far greater selection of listings with enough inventory on the market to easily carry 10 months of sales, almost 4 times longer than the Midtown communities to the south. To be fair to Willowdale, the condo segment is still holding strong with results that are largely consistent with the seller's market for condos happening across the city. Travel a few kilometers north across the border into York region and you'll find the broadest swaths of sluggishness in the GTA, with activity levels coming into moderate buyer's market territory for a number of the communities. Returning back to the 416, let's take a look at the key results from last month. Total sales in the City of Toronto came in at 1,879, down 6.7% compared to February of 2018. Fortunately, inventory levels are keeping to an appropriate level for the pace of sales. The ratio of sales to active listings, which gives months of inventory, is still hanging in at only 2.1, within a modest seller's market territory and even down slightly from a couple of months prior. In fact, buyers in a lot of the categories are finding that the quality and selection is limited. Although it can be argued it's a which came first, the chicken or the egg scenario, I'm of the mind that if there were a bit more inventory in the right segments, we might see higher numbers of transactions. It's also fair to put some blame on the lousy winter weather we had as being responsible for keeping some buyers in hibernation from the cold and a few sellers from listing while dirty ice mounds were killing their home's curb appeal. Weather is an easy scapegoat for when businesses don't meet their sales forecasts, so while I would say it had an impact, it's not like we faced a continuous blizzard for the whole month of February, so I'm not going to try to place full blame on our winter. Moving on to prices, detached homes in the City of Toronto came in at an average sale price of $1,294,000, which is up 1% compared to last year. Meanwhile, the Home Price Index benchmark came in slightly lower at an increase of 0.5%. Either way, detached homes are holding their value overall. As for semi-detached homes, the average was $1,087,000, up a healthy 10.3% over last year. It was a broad base of neighborhoods responsible for this increase, so it's pretty much been a good year to have owned a semi. Looking at condo townhouses in the 416, they came in at an average price of $671,000, down 4.9% over last year. If you own a condo town, don't panic, as the average price gets pulled up and down from month to month more than other segments. There just aren't that many condo towns that get sold in any given month, which makes the average price more susceptible to being skewed by a few additional central neighborhood luxury towns that happen to sell in that month. Moving on to condo apartments, the average selling price was at $612,000, up 7.4% over last year. The HBI benchmark even came in a bit higher than this, showing an increase of 8.7%. The downtown condo neighborhoods of C1 and C8, which dominate the market headlines, came in with a benchmark increase of 10%, but it is actually a smattering of condo pockets in both the East and West districts that eked out a few additional points. In terms of what to watch for going forward, starting next week we should see an influx of new listings coming online as the spring market kicks into gear. With hopefully improved weather and more inventory, there is apt to be more activity as buyers come out for better homes that owners have held back from listing during the polar vortex. In this period, from March to June, we typically see 40 to 45% of home sales for the entire year occurring in the 4 months. Because we also see a greater proportion of better quality and higher end homes sold in this period, the average selling prices for the year tend to be pulled upward. These two reasons are why so much attention is paid to the spring market. On the economic side, it wasn't long ago that further interest rate hikes seemed to be a sure thing. Now that the economy is teetering, signs are pointing towards prime rate stability for the rest of the year. On the fixed rate side, it wouldn't surprise me if they trend down in these coming months as banks compete with each other for market share to make up for their decline in mortgage originations. Whether it's stable variable rates or a slight decline in fixed rates, both are supportive of a healthy spring market. More notable on the mortgage front are the increasing calls for changes to the OSFI's expanded stress test that impacted a sizable chunk of buyers last year. Given that the OFSI is supposed to promote prudence in the banking industry while remaining independent of the government, it seems unlikely that the agency will yield to those calls to cut or cancel the stress test. On the other hand, with this being an election year, the federal government is apt to do something that is perceived as supportive of the housing market, especially given the weakness in the housing markets in other parts of the country. Longer amortizations may come up as a solution, which could very well offset the stress test and pull buyers to spending more in the market. I would say that this is the action to watch for from the feds, and if not, watch for the campaign promises along the same lines from at least one of the opposition parties. And with that, I'm going to wrap things up for this month. As always, if you want to know more specifically about what's happening in your segment of the market, or if I can assist you in any way with your next move into, around, or even out of the city, please get in touch. You can reach me directly by phone or text at 416-357-1059 or online through RebeccaLang.ca. Bye for now and have a great month of March.